Wait just a couple seconds. Okay, welcome everyone to this legal office hours. Today's topic, the do's and don'ts of the LOI. My name is Will Smith. I'm the host of the podcast Acquiring Minds and a partner in Minds Capital, a fund that invests in independent sponsors. Attorneys Bill Barlow, James David Williams are going to host this session. And today's topic was actually the one that James David and Bill presented as their first office hours with Acquiring Minds back last June. So it has been a year. The market has evolved. There have been some changes with the SBA you may have heard about. So it was time to revisit the topic. James David and Bill are, of course, partners in Barlow and Williams, a practice that specializes in small business M&A. They're at the front lines of this market. Their focus is helping searchers, sponsors like you all do your deals. They work both buy side and sell side, so they're familiar with both sides of the transactions that happen in this market. This is, You should also watch their other sessions. There have been 11 others. So this is number 12. That first one, do's and don'ts of the LOIs, part one, maybe skip since this is going to supersede that one, but they're all available on the Acquiring Minds website. The way we run these, as always, is that James David and Bill will give their presentation, then we'll do Q&A. Ask your questions using the Q&A function of Zoom. If you have a very detailed question or a question that maybe pertains to your particular deal, probably hard for us to answer that live, but ask it anyway. And James David and Bill will try to get you an answer after the fact directly by email. We're recording the session, and you'll receive a link to the recording by email in the coming days. That email will also include a link to today's slides and the LOI template that Barlow and Williams wrote and used. Okay, guys, Bill, James, David, welcome. Over to you.
Thank you, Will. Thanks for everyone for joining us. So today what we're going to be doing is we're going to be going over the LOI template and, going over the do's and don'ts of the LOI, I should say. Before we do that, just a quick word about us. So we're Barlow and Williams. We are a flat fee M&A law firm. So we do every transactions on a flat fee milestone-based payment. When you work with us, you work with us. As Will said, we're very active in this market. So, always feel free to reach out. One other thing that I'll just note, you will be getting the LOI template from Will as noted. We'll also be sending a follow-up email, and that email will have James David doing a live walkthrough of different deals that are on Biz Buy Sell and how you would fill out our LOI template based on those deals. So that's a really great resource for you. The link to those videos will be coming from us as well just after this presentation.
And I'll also add briefly, if you are going to use the Q&A function to ask a question, make sure you're not anonymous. If you're anonymous, I can't respond to you later. So if you see that you are anonymous, go ahead and put in your email right after that. I do respond to all of those questions. So people never believe that, but it's true. All right, so we'll start with what is the purpose of the LOI, right? So kind of that 30,000 foot view. The purpose of the LOI is to make sure that you actually have an agreement in place, right? You would be shocked, or maybe you wouldn't be shocked at how many times I've looked at LOIs that were signed that didn't have the actual terms of a deal in place. It's unfortunate when that happens. It's part of why we like to be involved before you sign an LOI. But the purpose of the LOI is to lay out all the main points of the transaction, right? And that's, and we'll talk about what those are, but it should be, think about it in terms of your attorney should be able to take the LOI and draft a purchase agreement without having to ask you multiple follow-ups, right? We kind of want that level of detail. And there's binding terms in the LOI, but most of it's non-binding from a legal perspective. But that's different from the reality of negotiations. Like when you put numbers in the LOI, those are binding unless something in diligence presents a reason why they shouldn't be, right? So don't be just flippant about your offer, right? Think about it in terms of like everything, like if all of the information that is presented to me is true, then I'm ready to complete the transaction on the terms in this offer, right? Because if you don't have that mentality, that kind of mindset, you're setting yourself up for the potential that the deal dies on you at the end, right? Some people use a strategy of, all right, just do anything to get it under LOI and then retrade later. That's a bad idea, right? And doing so can also get you blacklisted with brokers if you do it. So like it can have broader consequences too, but you can lose a deal, or you can just anger the seller so much that the seller wants to screw you post-closing, and that's maybe even worse. Um, anyway, now Bill, start talking, make us more positive.
Well, the exciting part is that you're getting to the point of submitting an LOI, which after a long search is really exciting that you found a company that's exciting to do that to. But you really do want to be clear about a couple things. And one of the first things you want to be clear about is what is it that you're offering to buy? So most commonly in deals of, using SBA 7A loans or even deals slightly higher than that, you'll prefer to do an asset purchase agreement. You'll be buying the assets instead of the stock. There's a couple main reasons for it. One is you get to shed some of those legacy liabilities because who knows what the previous owner did. Not all the legacy liabilities, but at least some of them. And then the other thing is that you'll be able to depreciate the assets, which basically gives you a tax shield as you move forward. So you want to make it very clear whether you're buying assets or stock. If you are intending to purchase stock, sometimes you want to do something called an F reorg. Sometimes, there are other things you can do. If you want to try to buy stock, but try and do something pre-closing to treat it like a asset purchase, you should just flag that. And most commonly, if you see that the seller is an S corporation, you would flag, hey, I want to, buy this as an F reorg, but a stock purchase. And just make sure the structure of your offer is clear. We have other calls where we kind of talk about like why you would do asset versus stock, and I'll kind of refer you to those other videos. But for this purpose, I want to say, just make sure you're clear what form you're taking. I'll also just say it is very common for us to see LOIs that have been prepared that say both. Like we will purchase 100% of the assets, including the equity of the seller. And that just leads to confusion. So just, pick a lane and kind of stick to it.
The next thing is the purchase price. This will be, in all likelihood, the first thing that the seller looks at when they receive the LOI. So I'm not completely against making it bold and underlined, frankly. But state the full purchase price very clearly and, bold it, underline it, or make it very clear. And, break it out into its parts, right? So how much is cash at close? How much is in a seller note? Are there multiple seller notes? How much is, if you're buying real estate, right? Break it out into its own thing, right? Make it very clear the terms of the offer. And then make it very clear what you're purchasing, right? If you know that certain things are going to be excluded, then state that. But more commonly, like if it's a commercial business with a bunch of inventory, say make it very clear that your purchase price includes the inventory, right? I've seen deals fall apart over things like that. I mean, it bleeds into working capital, but if you're not clear in things like that and whether you're buying the inventory, it can create confusion. And what you really don't want in the LOI is confusion, right? If you as the buyer think one thing and the seller thinks another thing, that's a problem, right? So again, globally, right, as you're preparing this document, you want clarity and you want to make sure that you actually have an agreement. Right? That's your overarching goal.
The next point is the basis of your valuation. So if you just put a number, you say, I'm buying this business for $4 million, that's the number that's going to stick in the seller's head. But we find that it is very useful to say how you arrived at that number. So you might say $4 million based on $1 million of trailing 12 months EBITDA, for instance. And what you're doing is you're saying, this is how I'm arriving at that number. And the reason why that's really important is because after you sign the LOI, one of the first things you're going to do is financial due diligence. And in financial due diligence, they might uncover that the EBITDA is actually not $1 million. It's actually $850,000, right? So that's a $150,000 difference. At 4 times EBITDA, that's a $600,000 reduction in purchase price. It is a lot easier for you to go back to the seller and say, hey, look, in my LOI, it said 4 million based on a $1 million EBITDA. Your EBITDA is now $850,000. So now it's a $3.4 million deal, right? And if you spelled that out in the LOI, it's a lot easier to do that and to be consistent. Whereas if you don't spell it out in the LOI, a lot of times sellers might regardless, feel bad about losing money, but at least there it feels like you've been upfront and honest about like how you're valuing the company so that it doesn't come as much of a surprise. I'll also just say for a moment that if there are other things that would impact valuation, right? I mean, most commonly these are certain metrics, but sometimes you might have assumptions about either key employees that are staying on with the business, key relationships with either customers or suppliers. Anything that you think if you uncovered would be a big deal, it might be worthwhile to put in here just as a signal saying, hey, I'm buying this business with these assumptions. If those assumptions turn out not to be true, my valuation may change.
Yeah. And I'll also preempt a question that we get sometimes, because some people are worried about, well, what happens if the number comes in higher after diligence? Would I have to pay more? That very, very rarely happens. And even if it does, oftentimes the seller is at the point of deal fatigue, and so they won't even ask for an increase in the purchase price. I have seen it a time or two, but just based purely on the percentages, it is much, much more likely that the numbers come in lower after the QOE than higher. So I wouldn't be especially concerned about that. Oh, skipped a slide. There we go. All right. Next thing is transition services. And again, here we're just trying to get to alignment. So you want to outline expectations. You don't have to say, well, you're going to be working this number of hours for this number of months. You can. We've seen LOIs get to the level of detail of, it's this many hours for the first month after closing. It's this many hours a week for the second month. It's this many for the third, right? That's kind of the level you'll get to in the purchase agreement. Sometimes you don't need to get to that in the LOI. Sometimes you do. Right? These are certain things matter more to certain sellers than others. The big thing here is to be mindful of the SBA limits, right? If you're purchasing the entirety of the business, then the seller can't, right? The seller must be an independent contractor and not an employee, and that relationship can only extend 12 months post-closing, right? If you write something in the LOI that doesn't work for the SBA rules and you want it to be an SBA transaction, then you're going to have problems with your lender, right? So another reason to work with attorneys before you sign the LOI is to make sure that it's going to work with the bank, because it's not a great thing when you have to go back to the seller, tail between your legs, because you wrote something in your offer that the bank vetoes. Another thing is, is there going to be additional compensation for transition services, right? Sometimes A lot of times buyers will push to have at least a certain amount of transition services included in the purchase price. You can do that as the buyer. Sometimes sellers are adamant that they'll get as what is effectively a salary post closing. I've seen sellers fixate on that at the expense of a lot of other deal terms sometimes, right? Everybody is, right, this is a personal thing. But you want to be clear, right? If you think you're getting 3 months of transition services as part of the purchase price, and the seller thinks that the seller is going to get, $50, $75, $100, $150 an hour for those services, that's a material difference in your overall purchase price. So again, clarity, clarity, clarity.
Another point you want to be clear about is that the seller is going to be expected to sign a non-compete and a non-solicit agreement. And oftentimes, like in our form LOI, we just state, the seller will sign a non-compete and non-solicit agreement. Sometimes you actually do want to clarify even beyond that. If you've had conversations with the seller and it's come up, and there's some, perhaps the seller already has another business that they want to exclude, or perhaps the seller is planning to move geographies and, start something in a new geography, then you want to be extra sure to clarify what this is. The standard is 5 years and pretty broad. We find that, a lot of sellers are often retiring and getting out of the business, and they're not that particularly interested in continuing to operate anywhere in the business. But it's also possible that sellers have adjacent businesses. So especially if you're in that second case, you can consider adding additional language in there.
And my mouse is acting up today. All right. So exclusivity. Be sure that you put it in your LOI. If it's not there, then the seller can continue to take offers from other people even after you've signed, and you probably don't want to be incurring all of the diligence costs unless you know that you're the only person in the game that the seller's talking to at that time. This is, the extent of exclusivity can often be heavily negotiated, but you need to make sure it's there before you start, before you start spending a bunch of money. There can also be mechanisms in the LOI to automatically extend exclusivity if you are, meeting certain milestones along the way to a deal, or if the seller doesn't get you the financials that your QOE provider needs, for example. That's probably a very common scenario, right? That maybe the exclusivity doesn't start until your QOE person gets everything they need, right? Because we have seen sellers that will run out the clock effectively that way. Although, frankly, if they're going to run out the clock on you, they're not going to sign anyway. But what you'll find in most deals is, if you get to the end of the exclusivity period and you're continuing to make progress on the deal, there's a clear path to close, right? The seller is not going to take it back to market. They may be willing to sign an extension of exclusivity, but the closer you get to close, the less likely they are to try to back out and shop the deal, because the seller deal fatigue is a real thing.
And one other thing, actually, before we get to the don'ts, is working capital. We should talk a little bit about that. It's very common for working capital not to be addressed in LOIs, and that's very much a mistake, because you want to make sure that if you expect the business to come with a normalized level of working capital, that the business comes with that normalized level of working capital. And that can be a difference of hundreds of thousands of dollars, maybe millions of dollars in larger deals, but there's often an expectation among sellers that they are keeping the working capital. And so if you don't front that, then you're setting yourself up for a fight. Now, that being said, I don't think you should actually put the number of the working capital in there, because you don't necessarily know what that right working capital number is. until you do financial due diligence and you actually kind of jump in, you really don't know. So we generally prefer you to just say, I am purchasing this company with the expectation that it includes a normalized level of net working capital. Another area that is another area of large fights is works in progress. So this is especially the case if you're talking about any type of company that has project based. So if they're, constructing things, or sometimes even manufacturers can have, projects that take months to complete. Oftentimes sellers kind of expect that the works in progress, either they're going to own them completely, or certainly they're going to get, a pro rata portion of that project if it's complete. Sometimes there's also customer deposits. So somebody might have put in money up front to start a project, but work hasn't begun yet, right? And you need to get that money because you need that money to do that work. So anything related to working capital, work in progress, customer deposits, sometimes you have subscription agreements where people pay for an annual plan. All of that should be addressed in the LOI because it's a material point. Assuming it's material to the business, it needs to be addressed in the LOI, because otherwise you're setting yourself up to pay all this money to do quality of earnings, maybe do legal, and then realize that you and the seller aren't actually aligned about how to handle those key things.
Yeah, and again, it's hard to put numbers on all of that, and it can be to your detriment to put numbers on it. So when you do look at our template, when you get it, right, you'll see that we kind of have in some of these working capital things, there's sort of a here's position A, here's position B, here's position C, depending on how aggressive the broker is, frankly. So now that we've talked about some of the things that you really need to address, we'll turn our attention to a couple of things that we don't like to see in LOIs. And there may be some people attending this webinar who don't like these next two slides, and I'm willing to live with that. So the first thing is earnest money deposits. So as we say, perhaps it's becoming a cliche at this point, but buying a business is not the same as buying a house, right? And because with the purchase of a house, I've never gone through that process, but I think you can kind of, it's kind of going to happen, right? There, you'll do the inspection, you'll negotiate the price down, and you'll still ultimately buy the house. Business buying is much less of a certainty, right? Many more variables involved. And so some of these concepts, like an earnest money deposit, that is incorporated from the real estate world, really doesn't belong in business buying. And it comes from brokers who come from the real estate background, right? And so what the broker's really concerned about, though, is your ability to close the transaction, right? The earnest money itself isn't the most important, right? The broker just wants to know that you're going to close, because if you can't get the money, then the broker can't get his or her commission, right? So, think about incentives. And brokers on competitive deals are getting, way too many people, submitting interest. Right? I've talked to brokers who will list something and get a couple hundred inquiries within 24 or 48 hours. Right? So the broker's biggest concern is, primary job in some ways, is to filter through all of that to see who can actually close. So, so don't use an earnest money deposit, right? Because that can have problems for you and create weird dynamics. But you need to do everything you can to demonstrate that you're a serious buyer, right? You have the funds, you have the support of a lender, you have investor support. This looks different. You have relevant industry experience. If you have it, you have geographic connections to the place. If you have it, right, go with whatever you have. But, demonstrate that you're a real buyer and you're not just a entrepreneur tourist who's doing this on a whim. Yeah, go ahead, Bill. Talk about some of the dynamics.
Yeah, I mean, a couple points on the deposit. One thing is that sometimes brokers will say, you know, like, again, I want to see some proof. If you have a pre-approval or pre-qualification letter from a bank, that's often kind of in this environment acts as your proof, because that means that somebody's looked at your bank account, your assets to say, hey, this person could fund an acquisition up to, whatever amount it is, right? So that's something that is commonly offered to brokers instead of deposits, is that letter that you would get from a potential lender. There are some brokers out there that will not do deals without deposits, and that will put you in a very sticky situation. If that happens, you're going to want to talk to an attorney before you sign anything that puts a deposit in. I'll just say, I mean, even if it's a refundable deposit, if it's a non-refundable deposit, then it's really difficult to sign something, because if something goes wrong in diligence and you lose $20,000, $30,000, $50,000, you just lose that money. So it's basically impossible to sign something that's non-refundable. But often it will be refundable, but even there you have to be careful, because we have dealt with several situations with clients that have put in refundable deposits, and then something has come up in diligence, and then they want to terminate the deal, but the money is kind of stuck there and gets stuck there for months, just because the seller feels aggrieved, or because it wants to be difficult, whatever it is. So just keep in mind, even if it's non-refundable, or sorry, even if it is refundable, you still have to be really careful about signing these deposits, and always talk to a lawyer before you sign up for anything like that. And that, I think, leads into the next point, which is using broker provided forms. Another thing that is common, frankly, the smaller the deal, the more common it is that you'll find this, is for the broker to say, hey, use my form for the LOI template. That's a bad idea. The only time that you should consider using that is if the broker insists on it and you also have an attorney look over it first, right? That's the only scenario in which I would ever use the broker provided forms. Keep in mind, broker provided forms are very seller friendly, because that's really who their client ultimately is. And they can also be binding. So, instead of an LOI, which, as we said, is non-binding to the extent that, hey, if you find out something is wrong with the business, you don't have to do the deal. Some of these are binding purchase agreements where you sign this document, you have to buy this company regardless of what happens in diligence, right? And even if they have a kind of out, right, it's not clear that out is sufficient to get you out of doing the deal to avoid a lawsuit. So never sign a broker provided form without consulting an attorney, and just be very aware. Another thing I'll just say is sometimes brokers will say, let's skip the LOI and go straight to the purchase agreement. No. and the reason is because the purchase agreement is binding and you don't want that. And you need to be able to do financial due diligence first. Because in a sense, what the LOI is there to do is say, hey, do we agree on terms and you definitely want to work with me and you don't want to work with anyone else? Okay, great. If we sign that, now I feel comfortable paying all the money to do the financial due diligence and the legal due diligence and all the other diligence, because that's expensive. That costs money, right? And you don't want to do that unless you really know that you're going to be one-on-one with this seller and they're willing to do the deal with you. So if a broker says, let's skip to the purchase agreement, that's just, frankly, it's just not feasible. It's just not how transactions happen at, any sort of larger scale. So.
And these will often be styled as offers to purchase, right? Is often how these are styled, these broker provided forms. And I've seen a range of these, and there are some brokerages, I won't name them on this video, but there are some brokerages that we just don't work with because of the process that they use with their offer to purchase forms, right? So there are brokerages out there that we have effectively blacklisted ourselves because of this issue. So just know that it is out there.
And you know, it is heartbreaking when you see a deal that looks like a really, really good deal, right? That you think this is exactly the type of deal that I'm looking for, but the broker is running a process like this because you're really playing Russian roulette and, you know, with more than one bullet. But it's because the problem is that even if, you know, they say it's a really good business, but if anything they say is not true, then that valuation is probably off and you have completely stopped yourself from being able to retrade. So this is where you'll get tempted. You know, you'll really, really want to do it, but just realize that, you know, there are some risks that are worth taking and not. And one risk not worth taking is signing a binding agreement to purchase a company without having done financial due diligence first. And financial due diligence is expensive, you know, so I know it sucks, but that's the reality of kind of the process you need to run and be disciplined about it.
Okay, so that is the end of the presentation deck. A bit of an emotional roller coaster. We didn't plan it to end on a negative there, but it's kind of unfortunate actually. But anyway, at least Bill got to be a little dour this time. Usually it's just me. Um, so
Sorry. Well, I guess anyway.
yeah, so I mean, I think there's already 20 something questions, and I'm sure they'll pour in.
We'll lighten the audience will lighten things up for us
Yeah.
here, James David.
Yes.
But anyway, I don't want to scare you, right? We don't want to scare people, right? The LOI, it's an important step. It's a big step. Do it right. You'll probably have to send several, right? It's very unlikely that you send one LOI and that's the business you buy. That's just the nature of how competitive business buying has become right now. And don't be afraid to send the LOI, right? A lot of people, this is one of the big kind of milestones in the search journey is sending that first LOI. If you have questions, you know, we talk to people probably, you know, weekly, maybe once every couple of weeks of somebody who has a few questions before they send their first one, right? And so we have that, we have those conversations, but you know, there comes a point when it's just like, all right, just send the damn thing, right? So don't get held up, right? Um, you know, have somebody review if you're sure that's what we're here for in some ways, but don't get hung up, right? Do actually send the LOI because you're not going to be able to get through the process unless you go through that step. I'll just finish there.
Sending the damn thing. Send the damn LOI. This is a phrase that floats around our world because as careful and thoughtful as you want to be with the LOI, it is classically also a psychological hurdle that searchers have a hard time getting over and can be you can be bottlenecking yourself at this point in the process. So just be aware of your own psychology and reticence to send the LOI. Got to send the damn thing.
No, even if you don't have all the information that you think you need, because that will almost always be true, right? So you for when you're drafting an LOI, you take the numbers as given, take everything that's presented to you as true, use that when you do it. But there's probably going to be things that they don't share with you and right, draft around that and still send it.
Okay. Questions are coming in fast and furious. Can we get to them?
Yep, let's see what happens this month.
Okay. First of all, guys, thank you. Excellent presentation as always. So educational, so accessible. Thank you for bringing such good quality to us. Actually, and before we get to the substance questions, quickly, if you would give us your pitch. What is it's actually, and a couple people are asking here specifically. Oh, I lost it. But if you would just talk about your fee, here it is. What are your flat fees? How are they determined? How does that work? Give us the quick pitch there, please.
Yeah, so our flat fees are done on a deal by deal basis. So we have a conversation, we talk about deal size, but we also talk about complexity, right? Whether you're buying real estate, if there's a franchise involved, if you need to do a tax reorganization. We have a conversation with you about your deal, and we also kind of go through all of the different factors that kind of impact the complexity, also whether you have investors, that type of stuff. And then at the end of that conversation, we go out and we give you, our flat fee quote. We're a little reticent to give you, exact numbers just because, one, our pricing tends to change, and two, sometimes we'll give a very simple deal. Somebody will get a lower price, and then everybody kind of expects that price, and that's just not, feasible necessarily. But I will say that, we've spoken, and our rates are very competitive. They're also sort of broken out by milestones, so you're not paying that whole amount up front. You're typically paying a small amount, like 10% up front, and then the remainder are kind of paid as certain milestones are hit, like drafting the agreements. And then we also have, a good amount of the fees deferred until closing, which helps with liquidity. We also tend to roll that kind of initial fee. So if it falls apart in financial due diligence, we have some fixed costs because we incur third-party costs, but we try to roll it at least for one transaction, because we know that you kind of have limited ammunition as far as that goes. So
Amazing. Thanks, Bill. Okay, we got a lot here. A couple follow-up questions to brokers saying use my LOI. Do you push back and hard no, or can you redline theirs? As long as you can make the edits, have your attorney look at it, redline it, and if they accept those, is that okay?
Yeah, we've navigated both scenarios. I've had people send an LOI that was done on our template. Broker sends it back in their version, and then we redline their version, and we roll forward. I've had people send LOIs prepared on ours that were just accepted, more or less. Just people just like, all right, good enough, and the broker went through a normal redlining process of that. I've had brokers completely ignore it and say, nope, you use our form or nothing. Right. So sadly, there is no uniform answer here. The biggest thing, again, is just to make sure that all the terms are actually there and that you're willing to do the transaction on those terms. Right. And
Okay.
if the broker's form, and there are a small number, but there are a few broker forms that are actually decent. Right. In which case, all right, maybe we tweak a couple of things, but then it's doable. So sadly, it depends on the broker. Can't give a uniform answer.
and
So,
that's why you would need to get an attorney involved to take a look, almost certainly. Which I know is terrible because nobody likes paying lawyer fees for a deal that you're not sure you're going to actually get, but at a certain point, that's just a reality. Sorry, does that answer your question, Will?
yeah, it does. And my only follow-up was about kind of the quality LOI, because somebody was asking about, like, what if it's the California Business Brokers Association, the CBBA, has their standard. So it's probably market tested. Is that acceptable? And I think the answer is the same. Well, it's hard to make a blanket yes or no statement here. It just comes down to the substance of what the LOI contains.
Yeah. And something else I'll also note just about these forms, especially if you're talking about like business broker association forms. I mean, business brokers, again, are representing sellers, and you have to keep that in mind. And, some of these business broker association forms might be like, a lot of times they're more acceptable at the lower end of the market, if I'm going to be completely honest. Like, if you're talking about some really smaller deals, sub $500,000, where it's going to be really difficult to get quality legal advice, and you use a form that's like on a thing. I mean, again, you should get a lawyer to review it with you first, but sometimes that can be a solution. We're not often the solution for that type of lawyer, because we generally don't do that kind of work. But as you move up market, if you're paying $1 million, $2 million, etc., like, then it makes less and less sense to use one of those kind of forms, even if they're kind of provided by some type of, National Broker Association stuff.
Okay. Great. When the sellers and or their brokers like all the terms discussed but do not agree on exclusivity during the period of due diligence, is there any other way we can persuade them?
Well, the issue is, I think this is the conversation you say. You're like, look, I'm about to pay $15,000-$20,000 to do financial due diligence on you, right? I'm about to go out of pocket a lot. And I'm just not going to do that unless I know that you and I are willing to do a deal and there's not some other person who's just going to come out of left field. And I mean, if they still don't agree to it, just, know that you're just putting that $15,000-$20,000 and then later your legal costs, which are even more, on top of that, at risk. So,
And sometimes there can be, this is where kind of that staged exclusivity can happen, right? It can be like, I get this amount of time to, submit an application to an SBA lender. I get this amount of time to get a term sheet from lenders. I get this amount of time to get to, whatever, right? Whatever the milestones are, right? You can kind of extend it, kind of milestone the exclusivity, and sometimes brokers are okay with that. What a broker is concerned about a lot of times is like, okay, well, I don't want to give you 90 days blanket exclusivity. I don't know if you can close, right? It comes back to that broker worry about being able to close. So again, the more you can confirm that you can actually close the deal, the less this is going to be an issue. But if it is an issue, right, talk about, well, I'm incurring all these costs, so I'm not going to do that unless I've got some certainty. And then, you can also have a conversation about kind of more clearly delineating an exclusivity timeline.
Yeah, and I'd just add that this is also data for you about your seller. If it's the seller who's insisting on this or being intractable, not a good sign, because first of all, they may just not understand that it's the industry. The norm here is exclusivity, so they're violating a norm. But if they don't have any M&A experience, they might not understand that. Their broker should. If their broker's the one insisting on it, the broker's clueless. But regardless of their awareness that this is a norm, it's pretty easy to understand, as you guys just outlined, why you buyer asking for exclusivity. And if they can't be reasonable with you there, it tells you something negative about them. So use it as data as well. Just say, not necessarily a red flag, but not a green flag, not a yellowish flag.
I mean, this is
Okay.
kind of the honeymoon period, right? So if the seller is being really difficult now, like they'll probably be really difficult, even more difficult in the purchase agreement and, afterwards, after closing. So just keep that in mind.
Yeah. Yeah. This is the honeymoon. What are market terms for exclusivity periods, due diligence periods? A couple people are asking.
We generally tell people to lead with 90 days. Usually it'll get dropped back to 60 days. Some brokers will kind of push for 30 days. The problem is that there's no way that you can get through your financial due diligence in 30 days. We've never seen SBA deals close within 30 days, and then you're kind of out of exclusivity, right? And so, 60 days really is the market. And usually the deals aren't closed by that point, but you're close enough that, you could just get an extension for another, 30 days or something, and then actually get it closed. If, as James David said, if the broker is being difficult about exclusivity and how long, we understand that they want like milestones to be hit, right? So you can say like, hey, I have this much time from, the period where I get all the financial items together from the seller, because sometimes the seller is the holdup. They're just not giving your finance folks what they need, right? And if you do 45 days from the day where the seller provides all of the financial information, then the clock only really starts ticking you know, at that point, then maybe it's more feasible. So.
Yes, the presentation will be shared for those asking. You'll get an email with a link to the recording, to the slides, and to the LOI template. What's a standard timeline you can expect the seller to sign your LOI? Any tips for encouraging progression if you haven't gotten your LOI back?
Yeah, I mean, I would say, you know, it kind of depends on how many LOIs they're reviewing, right? Because if this is the first time, if you're submitting the LOI and like, again, they've gotten maybe like 100, 200 offers, then it could take a couple weeks, right? If the field has been narrowed down, then I would expect usually you'd see like a response within the first week or so. You know, and something, it doesn't have to be like a full red line, but something like that.
And very rarely will a seller just sign the LOI as you sent it. But there is almost always negotiation about the LOI. Because in some ways, the pre-LOI period, right, when exclusivity has not kicked in, right, is the point of maximal leverage for the seller. Right. So when we represent sellers, we will push hard sometimes, not always, but sometimes we'll push really hard to get terms in the LOI to anchor a buyer to those terms. And this works both ways. Sometimes as a buyer, you want to do that with the seller also. But right, the leverage shifts post LOI because of this, what's on the slide right now, exclusivity.
I like this pair of questions from actually two different people. If you're not their lawyer, do you think that a buyer in the audience could use your LOI template without a lawyer reviewing it? Bit of a meta question there.
I
I'm
mean,
not going to advise it, and you'll see disclaimers on the first page of the template that I wrote saying that we're not providing legal advice and blah, 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 consult with an attorney, right? Of course, I'm going to say that. What we do generally encourage people to do, though, is use our template, submit it, and then come to us once you get a response. All right, we will help people. We help people on a regular basis go through it the first time, but once you've kind of gone through it, you should be able to use it. It's pretty user friendly, I've been told, and we really, you know, bring us in or use another attorney if you choose to do that, but bring an attorney in before you sign it. But you really should be able to use the template without having to talk to us. Some people choose to, that's fine. We talk to them, but the template is meant to be sent without attorney involvement, and then you bring attorneys in when you get some feedback from the seller to let you know that you're actually a finalist.
The second question was, what about using your LOI paired with ChatGPT?
So ChatGPT Lawyer, which we do see people do, but you have to be really careful using ChatGPT or Claude or Gemini or any of the others. Because one, the data set that they're trained on is a lot of public company documents and not private company transaction documents. So what's relevant to things that are publicly traded and have to do SEC filings may not be relevant to you. Often won't be. But also, I've seen these AI tools insert terms that are exactly the opposite of what you want. If you're the buyer, I've seen them put in the most seller-friendly terms possible and vice versa. So caveat emptor or buyer beware when it comes to using some of those tools.
and I'd say, you know, with these tools in general, you know, they're often better than somebody who's inexperienced, but compared to somebody who's experienced, and like the template is made exactly for your type of transaction, you know, updated with the latest SBA rules. Like the information set they have might not be updated for it. So, you know, we like those tools in general, but if you have a really good template, that good template is always better than whatever would be drafted by an AI tool.
James David, remind us or plug again your video walking through the template for those who came late.
Yeah, so we've just updated the website. I recorded a couple of videos on Sunday, actually, Sunday afternoon, where I go through, I found a few sample listings that I pulled, didn't have access to a SIM, so I was looking at just the listing, and I go through and draft an LOI based on that listing and annotate, you know, kind of do a voiceover as I go through that process. I've chose different offer structures for both of those to give people a sense kind of how the template works with some of those changes. It's in the resources tab of our page. I think it's using the LOI or something like that. But we'll also be sending that link out in the follow-up email that we will send. That'll be a separate email from what Will sends, but there will be a link in an email that we send later this week.
Well, I'd love to be able to just plop an email in right now. Is it this resources? Is it this resources link, James David? Working through an LOI template? Yes.
Yeah, and it's got 3 videos on it now. I will say that the third video on there was done prior to the SOP updates. So there may be a couple of things in there that are no longer current, but I still left it on the site as a way to just as another sample that people could have. And those are
Well,
about 20 minutes, 25 minutes each.
what a great idea. Check that out. I haven't watched the videos myself, everyone, but the concept is awesome. So there's the link, everyone in the chat. So click that, check that out. All right. Let's see here. Would love to hear your thoughts on forgivable seller notes as a trade-off to earnouts on SBA deals. How common are they? Does it restrict you on the banks that'll work with you? Should it be tied to revenue only or maybe revenue and margins? Any don'ts as opposed to do's for forgivable notes?
Yeah, so they are very common, and as stated, they are a sort of quasi replacement for an earnout. You shouldn't use the word earnout because that'll get your SBA lender scared. A couple things to note is they have to be based on historical metrics, so you can't just say like, you know, this you hit an increased level of revenue, and then, you know, if you don't, the seller note has to be given. It has to be based on historical metrics. It also is generally, you can't do things like this one customer stays with you, or like, you know, more specific things generally aren't allowed under the SBA. They are a great tool. They do make your offer slightly less competitive in the sense that, you know, the seller is saying, hey, am I going to get this cash? Yes or no? But it also can serve as a way for you to increase the total purchase price, right? Without, while still giving you downside protection in case it goes south.
And exactly what metrics are allowed, there is some variance between lenders. So there can be quite a bit of variance between lenders actually on what metrics will be allowed. But
yeah. And in terms of metrics, I'd say, you know, the simpler the better. Revenue, the great thing about revenue is that it's a lot harder to game, and it's a lot less likely to result in a dispute. EBITDA, you can do adjustments to EBITDA in many different ways, and it's much more common if you have an EBITDA based earnout and it's not hit, for the seller to basically it result in a dispute of some form. So keep that in mind as you're structuring it.
and if you are going to make a seller note forgivable, and you would see this in in the template. But if the seller note is meant to be forgivable, probably want to go ahead and put it in the LOI, because if you don't, it makes it an awkward conversation to add that later.
Yeah, 100%.
Yeah. So key point to underline there. It's great for us as buyers, but it does weaken the offer. It favors us, not them. So a seller's going to not perceive it as a positive. If it's in there, kind of needless to say.
Yeah, if you're the
Yeah.
seller, you sort of mentally discount anything that's a forgivable note because they have to do the percentage calculation that the relevant metric gets hit.
A clarification from somebody about what's legally binding in the LOI. So even though the LOI is not legally binding, the certain clauses are binding, the exclusivity.
Those will be
So
exclusivity, confidentiality, choice of law, dispute resolution.
Really,
Similar.
exclusivity and confidentiality are the biggest, you know.
fantastic. Okay, let me get through here. Okay, in an asset sale, is there any way to structure compensation for a seller who wants to continue working beyond 12 months that works under the SBA's limitations?
No. I mean, sometimes what ends up happening is you have them as a contractor for 12 months and, you know, there's a sort of, and again, we're not saying that this is a good thing that we recommend. We're just saying what the market is. Sometimes there's sort of an understanding that there's, you know, they might end up working longer than that. Really, if you want to do this in a way that's SBA compliant, you can have it as part of an additional forgivable seller note, right? So if you want to give them additional compensation, if you could find a way that works with a relevant metric, like, you know, revenue, giving them an addition to the purchase price and then have that be forgivable if that metric isn't hit, you know, that does work under the SBA. But paying them as an employee or contractor or anything else after the 12 months is not aligned with SBA requirements.
Because it sounds like, at least in the case of the questioner, the seller just wants to continue in the business, you know, I've had plenty of instances of that on the pod.
And that is one of the big problems with the latest SOP changes.
Yeah.
And one of the things I would personally like to see change, but there will be more changes. I think we'll see what they are. I don't have an inside angle to anybody in Washington, but yeah, I'm not going to recommend that I mean, if you put it in the agreements at closing, the lender is going to flag it and make you change it. But if you go outside of that, then it does put you in technical default of your SBA loan.
Or will they find out about it? Will they care about it? But you are.
And there can be consequences. You know, SBA loans are covenant free, you know, other than payment. But if you are even in technical default, it would make it a lot harder for that lender to work with you to extend further credit, for example. So.
And guys, let's actually flesh this out a little bit. So what we're talking about here is kind of what might be known as side letters or side agreements, where you have a kind of, you know, side agreement that the SBA doesn't know about, or the SBA lender doesn't know about, or shouldn't know about, with your seller to do something or that basically violates what the SBA said, the SBA rules. And this is something that's happened in the market. You hear about it, and for the very cases we're talking about right here. And so why I underline it is because didn't the new rules explicitly say no side letters? Which is a little redundant, but
yeah, that was specifically in relation to investors and investor control. With the technical edit. But it applies generally. And I mean, I've turned people away. Right? Well, I've turned prospects away who wanted to do this. So I'm not going to help you do it, but it does happen.
And I also think kind of there's a range when it comes to these things, right? There's a range from like, okay, well, you know, maybe this guy just likes doing stuff in the business, and so after the 12 months, probably if he, still likes doing things, we end up using him as a contractor or whatever. That's kind of the more benign side. And then you have all the way to things which kind of constitute fraud on the SBA, right? And so, that where you're like giving equity and you're really running around the SBA requirements in a way that is very significant. And so, it's just we generally don't, are much less comfortable with things that are really circumventing the main, those provisions, if that makes sense.
And given that these SBA rule changes are in reaction, well, I think it's in reaction to two things. This is kind of what I'm gathering. I also don't know anybody at the SBA, but first, that defaults are going up, so SBA loans are not performing. Actually, in the 7A category of business acquisitions, their default rate is less than other SBA loans. So it's our category of loan is still the best performing, but they're all default rates are all going up. So the SBA is trying to basically tighten credit, which happens when there starts to be defaults in any credit context. First, second, apparently, now this is my little intel, a higher up at SBA does not like search funds or kind of this quasi private equity that we're doing down here, which is why search funds themselves, search fund as a phrase was actually called out in the latest rule. So all to say that if it was ambiguous or gray or risky or unethical to do side letters or side agreements or knowingly violate the SBA rules before, there's basically something of a tightening. I don't want to say crackdown, but it's even a worse idea now going forward. So public service announcement.
And another thing I would say is like, also you can ask yourself this question, like, does this, if you are going to do something, here's another place where we actually see it, is that it's very common that the lenders will, be very cautious about loan repayment terms, right? And so you can't be obligated, like oftentimes you're deferring the seller note payments where you're not obligated to make payments under that seller note until, maybe it's on a 5-year standby. But sometimes because you can prepay under the note, you say to your seller, hey, look, I know the lender is saying, I'm gonna put you on standby for 5 years, but as a handshake, I want to try and pay you off faster than that. I just can't be obligated to pay you off faster than that, right? I have to have that flexibility. And that's where trust comes in with the relationship, right? Like, do they trust you to be a person of your word, that if you say, hey, I'm going to try and pay this off faster than I'm technically required to, that you're actually going to make the good faith effort to do that. So that's slightly different maybe from like the SBA requirements, but anyway, just something to keep in mind. And another thing to keep in mind, I always kind of do as the guiding star is like, if this is making it more likely that you're going to repay your loan and, having the involvement of this guy, whatever, I don't know. It's just, I know that really what we're trying to do is limit defaults under the SBA because we want to limit the defaults there. And that's, one thing to think about as you're deciding how to handle it.
Guys, we're 5 minutes over, starting to lose people to their other obligations of the day. So let's call it. Couple closing thoughts. Everybody, that link in the chat that's already there, that is James David walking through their LOI template using biz buy sell listings as sample, like how you construct your LOI using actual listings on biz buy sell. So And you'll also get an email from these guys with that same link. So if you don't click it now, that's okay. But really cool resource there. And then there in the chat also now is a link to their website, a link to James David's LinkedIn, Bill's LinkedIn. So connect with them there, their email addresses. And we've been recording. You'll get an email from me in the next day or two with with this recording and a link to the LOI or the LOI template and a link to the slides. And James, David, and Bill are going to follow up with their own email as well. So be watching your inboxes. Guys, anything else? Okay.
Great.
Well, thank you for a fantastic presentation. As always, Bill, James, David, just really, you add a ton of value with these webinars. We so appreciate them. Audience, thank you for your attention. And watch for next month. James, David, and Bill will be back. So we'll have another great session next month. Keep your eyes peeled. This ends the webinar. Thank you, everyone.